Good morning, good afternoon, everyone. Welcome to our discussion on how to find, fund, and grow your rental portfolio. My name is Ryan McBride. I'm the Chief Operating Officer of CoreVest Finance, and I'll be your moderator today. This is the third digital version of our Investor Pop-Up series, which is co-sponsored by CoreVest and SFRhub. It's a series that highlights relevant topics for residential real estate investors and helps to connect people in the space. Our Zoom webinars over the last several months have been great. We've had terrific audience attendance and participation, so thank you very much to those of you that have joined us. Hopefully in the not too distant future, we can get back on the road to in-person gatherings across the US, so fingers crossed. We're excited about today's topic, and we should be. It was selected by you, the audience. Again, it's how to find, fund, and grow your rental portfolio. And as usual, we have a number of experts on our panel that are going to provide real insights into the SFR rental market. In terms of the format, it's pretty straightforward. First, we're going to do a quick round of introductions. Then we're going to do a speed round with all the panelists for their view on the rental property market and where it's headed in 2021. And then the balance of the webinar will be spent answering audience questions. So thank you to those of you that have submitted your questions in advance. And if you haven't done so, or if you have another question as we go through the discussion, please submit via text in the Zoom app, and we'll do our best to address it during the discussion. And then also periodically through the discussion, we'll be sending out real-time survey questions. So stay tuned and please participate when you see those. So let's get to it. I'll kick off with my intro and then we'll go around the horn here. I've been in the space since 2010 as an equity investor, operator, and lender. Obviously, I'm spending a lot of time in the lending world these days in my role as COO at CoreVest. CoreVest, for those who don't know, is a nationwide lender focused exclusively on real estate investors. We've been around since 2014. We've closed over 10 billion in investor loans, and we've financed a range of different property types: single family, condos, townhomes, multifamily, and even some mixed use. The best way to think about our products is they come in two main buckets. The first are term loans, and those are typically 5 and 10-year term loans that are fixed rate, and those are used to finance portfolios of rental properties. Our second bucket is our bridge loans, and those are credit lines and can be individual project financings. And those are really used for a range of different things. So rental aggregation, fix and flip, rehabs, new construction financing. Oftentimes we have customers that marry up a couple of our loan products. Build to Rent's a great example where we'll provide the construction financing, stabilization financing through our bridge side, and then provide the takeout financing with a term loan. So that's it for me. I'm going to pass it on to my friend, Mr. Michael Finch at SFRhub, and let him go through his background.
Thank you, Ryan, and thank you everybody else for joining today and everybody else that's listening in. Michael Finch here, SVN, SFRhub Advisors, and SFRhub.com. We have a kind of a suite of companies under the SFRhub umbrella. Today we'll primarily be talking about our commercial brokerage, SVN, SFRhub Advisors, and how we're playing in the market and working with buyers and sellers in the build for rent portfolio and single family portfolio investment space, and SFRhub.com being a separate company that powers our brokerage as a data valuation and digital technology platform that really powers our brokerage and allows us to do what we do to the benefit of hopefully everybody out there. I'll leave it at that and look forward to a further discussion here.
Great, thanks, Michael. Chris Garner, do you want to go next?
Yeah, my name is Chris Garner with Garner Properties and Management and Investment Realty Services. We run a property management company in the Michigan, Detroit area, manage over, right now, a little over 1,800 properties. I'm also the lead partner on an investment group, a foreign investment group that has invested in over 900 single family homes in the last 5 years in this market. I also operate some management in Indiana. The rental market has been absolutely fabulous, as most of you can probably know. And we have used CoreVest we just closed our 17th loan on different portfolios with CoreVest last week. Again, looking forward to this discussion, like Mike said, and hearing some questions from everybody. And Ryan, that's it. Back to you.
Perfect. Thanks, Chris. Rima, do you want to go next?
Sure. Thank you today for having me on this panel. My name is Rima Patel, and I'm the General Counsel and Chief Operations Officer at CS Equities. We're located here in Birmingham, Alabama, and I've been with the company for about 7 years. So we're a vertically integrated company. We do everything from purchasing to actually managing the properties themselves. So we see it all. So as you know, you probably see lots of legal and operational issues on a daily basis. So that's what I do. But along with that, I do all of the financing side as well as the investor relations side. So we're working on our 16th loan with CoreVest right now, and we're excited about what the future holds.
Terrific. Thank you. Danielle, do you want to go next?
Sure. My name is Danielle Crowell, COO and co-founder of Equity Connect out here in Phoenix, Arizona. We're primarily a single family residential fix and flip and buy and hold investment group. We're a little bit different in that we have a whole acquisition arm in which we use to acquire all of our properties. We consistently market in the Phoenix and Las Vegas areas and have a team of analysts that work with homeowners to buy their homes off market. And recently we've branched into the build for rent space. We've got a few communities going here in the Phoenix area. So we're looking forward to taking advantage of some of that agency financing and, scaling from there with that strategy. And thank you for having me today.
Of course. Terrific. Welcome. Jason, you're batting cleanup. Do you want to go next?
Yeah, thanks again for having me. Jason Green with Roofstock. I've been in real estate since 2003, and I'm a licensed broker in over 10 states. Roofstock is a marketplace for people to buy and sell tenant occupied cash flowing rental properties, as well as portfolios and build to rent. So look forward to discussing with everyone.
Terrific. Thanks. All right, well, great job on the intros, and we're going to move to the next component here, which is our speed round. And so that's going to be a couple minutes each for each of our panelists, just to provide a few thoughts on their outlook for 2021, whether it's their personal portfolio outlook, the market outlook, something new that they're planning to try, but something that's certainly relevant to the SFR space here. I'll kick it off with a few commentary from our side, really as a nationwide lender. I know Chris mentioned it, and I think most folks joining today realize that the SFR business held up incredibly well in 2020. And the second half of the year in particular was on fire. So we're exiting that year and into this year in a very strong position, and we see that continuing. There are a number of trends that I think helped accelerate the sector's growth, really due to COVID in certain cases, where people moving from cities or dense apartment stacks, looking for SFRs for more space, people having to change their living situation to accommodate work from home, or often expanded households. You got to love those returning college kids and others, right? But I think it's also important to note that many of these underlying growth trends were already in place. Shifting attitudes towards rentals, increased supply of high quality rental options have really come online over the last several years. And then just the overall demographic factors in several areas were really favoring rentals, in a lot of cases in lieu of home ownership. So, with that, we've obviously seen a lot of investment coming into the space. It seems like every week there's another announcement for a big investor coming in, partnering with a public REIT, a home builder, mid-sized funds, what you might have, and build to rent in particular. We've done a few conversations on that, in this format, but that continues to be a really interesting space for a lot of people. Sounds like, Danielle, you guys are going to be headed that way this coming year. But, there were over 51,000 units last year that were, for build to rent exclusively. And that's a huge number. And this year it's supposed to be, even more than that. So it'll be really interesting to see how these factors play out. So that's enough of me. I'd be really interested to hear, and I think the rest of the webinar, with what our panel see coming up for this coming year. So Chris, why don't you get us started off with your views and you think where we're headed?
Yeah, I don't see any headwinds affecting this the SFR market, rental market from 2020. We're seeing a steady increase in rental rates throughout our portfolios. The upside is that you have in our market really strong appreciation of values over the last 2 years, and that's continuing into the first quarter of this year. The downside is you have for acquisitions, you have an appreciation of value. So there's a little bit of an offset, but the good news is that we are forecasting rental rates in our market increasing between 3 to 7% in the overall market. In certain groups, certain areas or pockets are going to be a little bit more. So I am very excited about this market in 21 and the possibility of acquisitions. And then also, like Ryan, like you said, build to rent in this market is hot also.
Got it. Okay, Danielle, what are you seeing? What do you think is going to happen in 2021 here?
We're very bullish on the build for rent and just in general acquiring single family homes to hold for the purpose of rent. We believe, over the last year, we've seen rents increase at a even 15% rate in Phoenix. A lot of people, I can only really speak to, our markets here, but, a lot of people are moving in. We've seen a ton of migration just in general to Phoenix, but then COVID related migration has really increased the need for homes here. And we have a significant shortage. We're at an all-time low for available homes. And I think a lot of REITs are coming in to build to meet that demand. So we're jumping on because we see a long runway for this market.
Yeah, 15% rent increases. That's astonishing. Jason, what are you and the good people at Roofstock forecast this coming year?
It's unbelievable how much capital is wanting to come into the space, whether it's build to rent or stabilized scattered site portfolios. We just closed a rather large transaction, and we were kind of reflecting on it. And 18 months ago, we may have had 5 to 7 different bidders who could take down a portfolio that size. And now we're talking to 20, 30 different pools of capital who are looking for these size and scale of deals. So it's been pretty unbelievable to watch kind of the maturation over time. Certainly that comes with yield compression in some of the major markets like Phoenix, like Dallas, like Charlotte, like Atlanta. We're seeing more groups willing to wade into kind of the Midwest and more, Rust Belt type markets like St. Louis, Memphis and kind of that Midwest area, because there's still, a little more potential yield on the bone in some of those older, kind of older guard markets. We're excited about the headwinds though. There's a lot of interesting things happening in build to rent. I feel like just in the last 6 months, that subset of the market has changed dramatically where, even publicly traded REITs are willing to get into development at the raw land stage, which I don't think you could say 18 months ago either. So it's been really interesting to see groups getting in early on development and placing capital early in that development cycle. Whereas, again, 18 months ago, most groups were just buying closeouts from Lennar or other builders as they needed to hit their quarter numbers. Now groups are actually developing their own individual communities. It's been happening for years, but just not at the scale that we're seeing. And the amount of interest is driving land prices up. And so we're interested to see how that plays out. But all in all, I think you can say like everything circling this space is exciting. Our leasing has done really well. Our sales have done really well. There was certainly some early angst when COVID hit end of March and April last year, and the lending world kind of shut down a little bit. But it's roared back in a fabulous way, and we're excited about the opportunities that lie this year for ourselves and everyone else in the space as it continues to mature.
Got it. Thanks. And Rima, how about you? What are
So
you?
we're really excited about the rental market this year. I think with COVID happening, people are really invested in finding a place to stay where they can kind of grow into. They can have their families, a backyard, and they can just have that space. So
Right.
they're at home all day. So people are really wanting to find a rental space that works for them. And because of that, I think we've seen a 99% occupancy rate in our stabilized properties, and people want to stay. They're loving the rental market. They're happy where they are, and they just are kind of content. And we're also seeing that with the price of properties just being so high, it's harder to be a homeowner. So there's limited inventory out there. People are just wanting to to find a place with us and they're happy. And especially in Birmingham, we're seeing a lot of growth with industries. So lots of influx of jobs, unemployment's pretty low, it's stabilized. So everyone is kind of really wanting to expand in this market and stay as renters. So we're really excited about the growth that we see in the future.
Terrific. And Michael, what do you think for this year?
You know, I echo everyone's comments here, and Jason made a lot of good points. I mean, we, you know, at the beginning this time last year, you know, we were anticipating 2020 being the year of build for rent, and you know, obviously we all know what happened. But you know, we had a couple $100 million in escrow in March, and I'd say 80% of that was build for rent deals, and of course it all went away. And you know, what has happened since is, you know, like Jason mentioned again, you know, the lenders and the equity markets, you know, started reopening in July, you know, August, and you know, you listen to John Burns or you know, Ivy or whoever, and all the marketing has you know, indicated just how strong of a market single family investments are. COVID has proven once again that it is the most stable asset class in the country and is outpacing every single other commercial real estate asset class. And we're seeing, you know, we're seeing all that activity again, and we have been since probably September, you know, where the investors were really coming back, and then all the new capital that's coming in, whether they're partnering with, you know, existing platforms, you know, or trying to figure out build for rent, you know, but we're right back literally where we were last year at this time. We've got over, I don't know, 60, 70 million in escrow right now. We're negotiating about another 150 million in build for rent deals right now, you know, with buyers. And it is just a phenomenal market. You know, I think some of the challenges are going to be, you know, these kind of astonishing home price increases, because, you know, everything's appreciating faster than rents are growing, and rents are growing pretty darn fast in a lot of markets. You know, and builders are, you know, are very happy with the for sale market right now if they can even find the lots to keep creating inventory. So it's going to put a little pressure on how you're going to negotiate the build for rent deals. And I think it's going to be imperative to, you know, make sure that you have a really good understanding of development and building when you're negotiating with these types of groups, because it's not just, hey, we've got money and we want to buy homes for you. You really got to be able to speak builder language, which is, you know, why we've been so successful in the build for rent space, because we've developed and built on every asset class in commercial real estate under roof here in our former lives. So we understand development and builder speak, and but yeah, I mean, it's going to be a phenomenal 2021. I mean, all signs are pointing in the right direction. So fingers crossed. You know, we don't have a March 2020. We should all be in good shape moving forward.
Yeah, definitely fingers crossed. But it seems like we're pretty universal in our outlook. This is going to should be a good year for the rental market, SFR in general. Before we get into a Q&A, I know we're going to pause for a minute here. We're going to do a couple survey questions. So I'll ask Tuan to tee those up so that we can see what the audience responses are. Okay, terrific. Okay, so I am a developer, investor, broker, property manager, or other. All right, so it looks like we have a lot of investors on the call today, which is great. I think we have one more here, and then we'll get into the audience Q&A. Okay, in 2020, my business was booming, good, okay, not great, or disastrous. Based on the panel we just heard from, I think I know which way this is going to go, but we'll see.
Depends on what part of the year.
That's true. That's true. Well, recency bias, right? Everybody, I think, is focusing on the second half and what happened in Q4. At least that's what we do around here. There we go. So it sounds like 65% or so had a good to booming year, which is great. Hopefully those that didn't have a great year change it up this coming year. Okay, well, let's move on. We have some audience questions that were submitted ahead of time, and we're starting to get some through. And so just reiterate to the other folks, on the webinar that are joining us, feel free and please do submit your questions to the live Q&A, and we'll do our best to get to those questions that come in. Chris, one question we had here was, you've had a long ride in the Detroit market. Strong commitment there in the past. Are you continuing to focus on Detroit, or are you going to look to invest elsewhere to expand the empire?
So our main focus is in the metro area, not in the actual city of. So we do a lot of, the suburban area.
Right.
We're expanding that out into a couple different counties west of Detroit. But this area has just, really taken off in regards to economics. The auto industry is stabilized. We're seeing huge, Amazon just came in and built another 1.6 million square foot distribution by the airport, which is close to us. I mean, it's just it's a really strong market across the board. So
right.
I'm in it.
Got it. Do you see any other markets, with similar characteristics that are exciting to you, or are you going to largely stay close to home at this point?
The only the market that I'm in is in Indianapolis, and that is very similar to what's going on in Michigan in regards to the Midwest. I know there's a lot of West Coast in Phoenix and the panel, but and I'm familiar with Ohio, Columbus, Cincinnati areas are also very strong. So, I mean, the Midwest is a little slow on some of the uptake in regards to appreciation and rent values increasing so dramatically, but it's long, steady gain for us. So,
got it. Thanks. Michael, question for you. If you're a small or a mid-sized investor, so small, mid-sized portfolio, and you want to grow what you're doing, where do you think the opportunities are going to be? Geographically, price points. You're seeing a lot of deals come across. What do you think for those types of groups?
I think for the small and mid-sized guys, it's avoiding the primary markets where the big capital is going. And to Chris's point, the Midwest is a great market. For the smaller and mid-sized investors. You've got long-term tenancy. You've got more affordable homes. You can probably find higher yields in those secondary and tertiary markets. So we just brought out a portfolio in the Quad Cities, which if anybody doesn't know, is right on the border of Illinois and Iowa. Happens to be my hometown, just coincidentally. But it's about 151 units. Nice stable portfolio. We just went into contract on a suburban Chicago deal, a receivership deal. Chris, we're working on bringing out a couple large packages in the Detroit metro area. But yeah, I think for the biggest bang for your buck is really focusing on some secondary markets. And I say this on every webinar. I love Northwest Arkansas. For those that have not looked at the Fayetteville, Bentonville, Rogers, Springdale area, tons of affluence, great rental market, did better in the last recession than any market in the country from a single family rental standpoint. But yeah, I think good core, to Jason's point earlier, the good core Midwest and Rust Belt markets are great places to start to find, a long-term rentership and good yields for your price.
Got it. I think that's very interesting. We're starting as a lender to see so much more opportunity, in secondary cities across the Midwest. I don't know if it's polite to say the Rust Belt, but the Rust Belt, I think those are markets that were overlooked by institutions, but as we turf up more and more opportunities, we see more and more investors with large portfolios, attractive priced collateral, and then really strong rents with a lot of tenancy, a lot of growth, which is really interesting to see.
And long-term, I mean, again, I mentioned I grew up in the Quad Cities, but my mom rented a home for 15 years before she purchased when I was in high school, and that's not uncommon in a lot of these markets.
Right. And so Rima, you're very focused in the Southeast, and in particular, Alabama. What are some of the trends that you're seeing there in Alabama? There's certainly, I think Birmingham has caught a lot of people, not by surprise, but that's really turned into a pretty hot market, as Huntsville and some of the others. What can you tell us about your market?
So we're seeing a lot of growth, I think mainly because of the industries that are coming into this area.
Mhm.
We have Mercedes in Tuscaloosa, we have Honda in Talladega, we have Hyundai in Montgomery, Toyota and Mazda in Huntsville, and then we have the Airbus in Mobile. So those five, just the automobile industry has really brought a lot of job growth. So people have been able to want to shift in this area because of that, and unemployment's kind of low, and so we're seeing a lot of inventory being filled because of that particular reason. And like I said, our unemployment didn't get hit much. We didn't have a lot of issues on that. So again, because of those metropolitan cities outside of Birmingham, we're still seeing a lot of growth there. And again, I mean, we just have a lot of developing industry, and it's a little hidden gem. So I think that Birmingham and the metro areas are going to do well because of that.
Have you had any issues or any impact from eviction or foreclosure moratoriums?
So yeah, the moratoriums really were related to the FHA loans. So we were still purchasing in 2020 through sales of ones that were popping up, but we're kind of waiting for that moratorium to be lifted because there's a lot of idle just inventory that we think is sitting there that we're kind of anticipating will come back up in 2021.
Got it. And Danielle, how about you? Are you're obviously in the Phoenix market, the Las Vegas market. Are you seeing any impacts from eviction, foreclosure moratoriums, anything along those lines?
Our portfolio personally, we did not have any real issues with evictions and whatnot. But I would say that on the acquisition side, due to the lack of financial distress and people needing to sell due to a pending eviction or pending foreclosure, it's been less. It's been more difficult to acquire properties, just because that's typically the type of seller that comes to us. So.
Got it. And I guess since I have you, there's so much, it seems like there's so much interest in the Phoenix market and a lot of competition. How do you find new product? How do you guys get creative to, grow and build your portfolio?
Yeah, it's very difficult. Phoenix is one of the most competitive markets. We spend a good amount of money every month on marketing through direct mail. We've got a call center, website, and various. We try to stay on top of the marketing trends, and we also make a lot of offers on market properties, just because. There's a lot of opportunity there as well. So I would say that's been successful for us.
Right. It seems like anybody who wants to start a business in SFR, they kind of look at Phoenix first, right? Whether it's the iBuyers or build to rent, and there's some of these kind of branded Airbnb experiences. It's such an interesting kind of test market for a lot of what's going on here.
Yeah, I would say that a lot of REITs have come into this area, and I think everybody's just seeing that. I think we were number 2 in net migration last year. So there's just a lot of demand that's pushing up the amount of money that's coming into the space.
Got it. Jason, so from Roofstock's perspective, it's clearly a seller's market. Are you seeing small, mid-size, or even larger size group, looking at, hey, this is my time to exit at a nice premium? Are you seeing a lot of inventory from that standpoint, or are most people kind of recommitting to the space?
I think it's a little bit of both. I think there's some early funds that started in 2013 and 14 that are coming to the end of their kind of fund or vehicle life. That are looking to kind of capitalize on their appreciation and upside, and not necessarily that they're exiting completely, but they may kind of shift those funds into other ventures, maybe build to rent.
Yeah.
We are seeing definitely it being a seller's market. The amount of interest on the bulk portfolios has been, absolutely unbelievable. We just closed a $260 million plus deal. And, again, a few years ago, there may have only been a couple of bids for a deal of that size. And to see, 10, 20, 30 groups submit proposals on a deal like that just tells you the amount of capital that's out there looking. I think early LPs are definitely smiling about their investments in 2014 and 15 and,
right.
Some of those bigger funds. But we're talking to a lot of those groups, and it is not like a full exit out of SFR. It's more of an end of fund, and how do we put those funds to work into build to rent or one of the other newer verticals that's starting to pop up. So it's been really interesting to see. There's only one real group I know of where we're marketing their portfolio that doesn't plan to operate anymore. But on the flip side of that, they're looking to place debt and equity in the build to rent projects. So they're not necessarily leaving, they're just kind of shifting their strategy.
Got it. Just scrolling through some of the Q&A, and maybe Michael, this one's for you, just given, you spend a lot of time on build to rent and with builders. Really a comment on kind of labor and lumber costs increasing. Are you seeing that trickle through in terms of markets that people are focused on, or price points for homes, things like that? And how is that kind of manifesting itself in what you're saying?
I mean, it's everywhere. It's affecting, from coast to coast, which is, a little bit why I mentioned you really got to start understanding in the build for rent space, and or working with groups that understand it to help you get through that process with a builder. Like we've been, for example, we were negotiating some deals that should be opening escrow this Friday, but we had negotiated a deal back in July, August, and then lumber just kept going up and up, and material costs kept going up, and they had significant costs, and they just couldn't strike the deal where it was, and with the COVID and labor shortages, just everything was getting more challenging. But on the flip side, we were also watching rents grow, and go up, and we were able to, negotiate through all of that, given our knowledge and insight in development and building, and we were able to hold on to that deal, and it's taken longer than we had anticipated. But the deal is still in play, and it's still a good deal for the buyer. We've, similar situation. We just brought a phenomenal offer on a build for rent deal, 6% off asking price. And because lumber was ticking back down a couple months ago and now has gone back up, the builder again is absorbing about an $8,000 cost increase per home, and it's making it challenging to bridge that gap. So we're going to work with the builder and the buyer to see, where we can help pull some costs out, if there are some costs, which I'm sure there are on the builder side. And it's just really, understanding, the development and build budget, and working through some of those hurdles, because it's affecting everything, material and cost increases, supply chain constraints, labor constraints, it's affecting everybody today. So, the prices are going up.
Right. I'll take this one. One came in on the risk of long-term lender rates jumping again like they did at the beginning of COVID for investment properties. Certainly there was a period of time, I think, from, let's just call it, the March timeframe, maybe a little bit into April, where rates did gap out a little bit. And I think that, we're a lender that works pretty heavily with the capital markets, as do just about any other lender, unless it's somebody that's writing checks off the back of the pickup truck. But we, like others, when there's uncertainty in the market, as there was in the early days of COVID, and just not knowing what's going to happen, the next day, the next week, the next month, you tend to have risk premium go through the roof. And so I think there was some gapping out in terms of what the risk premium was in the capital markets, and that kind of flows all the way through the financing ecosystem. And I think that as we got through March, April, people realized that this wasn't another financial crisis, that the capital markets, the debt markets were strong, banks were very strong. We weren't going to see anything that happened like we did in the great financial crisis with securities and other, whether it's debt or even equities, having a massive price displacement. And I think a combination of the Fed coming in saying, look, the checkbook's open, we're going to make sure everybody has enough liquidity to move on. I think that was really helpful to stabilize the market. And if you fast forward to where we are today, whether it's long-term financing rates for rental portfolios or even bridge financings, we're pretty close to an all-time low in terms of the rates that folks are able to get for their portfolio financing, for their short-term financing needs. And I think a lot of that is risk premium has really come in. You also have the base rates, which are still quite low. The 5 and the 10 years in LIBOR and everything else that lenders like us and others use to benchmark their loan pricing. And I think the one thing that is really important for folks to hear is this asset class has performed incredibly well over the years, not just the institutions, but also folks like our panelists and others on the webinar. And those that are in the capital markets, debt capital markets, recognize that, and they have been, very supportive of this as an asset class. They realize it's not a trade; it's an asset class now. So there's much more interest from lenders all around, which is a good thing, in the sense you bring in more groups to the space. There are more options for people. Pricing is lower, so. That's a very long wind up to say, I don't think there's going to be a lot of risk in terms of, rates gapping out. You might have an event here and there that will cause that, but I think overall the structure of the market, the belief in the space by the debt capital markets is incredibly strong. There's a lot of alternatives for folks out there to finance their properties. And so I think as you're looking to build up a portfolio or do short-term strategies with bridge financing, it should be in good shape from financing rates going forward here. Rima, I'm going to have a somewhat related question for you. I know that you, in your position, you handle a lot of the financing. Maybe just comment on your view in terms of having a solid financing plan as you're looking to build up and scale a rental business. How much of a component is that to what it is that you and your team thinks about? Well, I think you're on mute, by the way. Yep, there we go.
Sorry about that.
No
So
worries.
it really does allow us to expand. If we don't have a good partner or a good relationship in the lending side, we really couldn't grow. So even with COVID happening, and in the beginning we were kind of scared, we still ended up closing on a loan with CoreVest, and it worked out that because we were still able to buy those assets that kept coming through the end of the quarter. So it really does help you grow, and it allows you to do more. I think organization and processes are very important. And as long as you have that kind of relationship with a financier and you're process oriented and you work well together, I think it can really, really help with the growth side of your business.
Got it. Thank you. Chris, I'm going to ask you a question about your view on it came in just recently on the opportunity of in the urban core. I know that you mentioned that you're in Detroit, but you're in the surrounding areas. Do you have a sense on, does it ever make sense to go into the urban core in Detroit or other markets, other similar markets?
I think there's definitely some opportunity there for the right type of investor that they're taking on some additional risk. But we, at one time I managed over 800 properties in the city of Detroit and started my exit about 5 years ago, just because the cost of operation was just so high for the investor and the landowner. And I see other urban core areas that have the same types of issues, and the rents have not increased that much, but the property values are relatively lower compared to urban areas. So there's yield there, and there's gaps there that you can make it work for the right type of investor. it's definitely a more hands-on approach. It's a more labor intensive to manage and to keep operations at a level that they're generating returns and to protect the property. So I mean, that's just my experience with where I'm at. I'm sure there's other urban areas that are that might be different.
Jason, maybe you can build on that. Are you just, given what you have for sale on the platform, is, I would imagine there's a mix, but do you see it skewing heavily outside the core, or is there still adequate interest in investing in urban cores? I saw another question earlier about Chicago, San Francisco, other large cities with big rent declines. Is there going to be interest in those cities coming back at some point?
Yeah, I mean, I think there's always going to be interest in cities like California, especially like San Francisco and LA, especially from foreign and international investors. I think there is quite a bit of money going out of California, as I think people read the headlines and see that. But I think there'll always be interest in those markets, especially now that people can feel like they're getting in at a little bit of a value premium because the rents have decreased, prices have decreased in turn for some of those multifamily and other assets in the urban core. I don't think people are going to go away completely from the urban core. I don't quite believe that. I mean, certainly companies are having to adjust to work remote, and I think that'll be a trend that continues even once things fully go back to normal. We are seeing more and more sales and especially development going on outside of the urban core. That's where land is available at prices that make sense for home builders and for build to rent. It is hard to get infill urban core land that pencils for rentals at this point. In the major markets, we're just not seeing it. So I think you will see a development trend going outside of the urban core and people looking for more space and to spread out. I don't expect it to be wide sale though, where people are like abandoning the urban core investment thesis. I just think it's shifting a little bit.
Got it. Thanks. I'm going to pause it right now for another set of survey questions, and I'll ask Tuan to tee those up right now. Let everybody catch their breath a little bit here. Tuan, do you want to broadcast those? Perfect. Okay. We'll see what the audience thinks in terms of the SFR market in 2021, whether it's going to be on fire, better, unchanged, worse than 2020, or ice cold. See if we have any contrarians here. Yeah, it looks like the group is all in the better to on fire category. So as we expected, let's do the next one. This year, I plan to invest in build for rent, existing single family rentals, fix and flips, multifamily, others, and you can do more than one choice for this one. We have that technology. All right, looks like there's a lot of existing housing stock that's in play, and a lot of people doing build to rent. It's great. Thanks, Tuan. I like this question that came in. We have this debate all the time and comes up frequently, and it really comes to valuation. And Michael, maybe I'll tee this one up for you, but it's are we going to see a less subjective measure of valuation on single family rentals based more on performance of the portfolios like we see in multifamily, i.e. cap rates, et cetera, versus appraised value, which we typically see in residential rental? What are your thoughts on that?
I would certainly hope so. It's clearly an income producing asset. It's becoming more and more institutionalized by the minute. They're cash flowing assets, and they should be looked at as such. I have a significant multifamily background, and it's not looked that way at all. Even like the worst property in town can still get financed if it's cash flowing. Unlike what we and a lot of the investors have to deal with, which are certain pricing valuations in the SFR world. I think there's a great opportunity to really you know, start looking at it in you know, that more commercial asset type of way. Ryan, you'd probably have some really good insight on that, more than I, but I mean, I 100% agree that it should be viewed much more on an income approach, and you know, if it's going to cover the debt service, you know, ratio, and you know, whether or not they're not the best homes doesn't mean that they're not going to rent. You know, it's certainly happening in build for rent, you know, where they're going to be valued based on income once stabilized,
Right.
as opposed to, you know, buying at CO. But in the existing, you know, SFR portfolio space, I would love to see portfolios valued more on income than individual values of the homes.
Yeah, it's an interesting question, and
It is.
the reason I like it is because it comes up a lot, and I think it needs to be addressed, but it's going to be something that happens over time, right?
Well,
As
yeah.
you mentioned, and particularly in build to rent or other situations where you have, you know, multiple assets on a single tax parcel, for instance, that's really a revenue or a, you know, an income generating investment. It's really hard to split that up in a lot of cases, and so that really should be more of a you know, cap rate based approach versus trying to come up with a not that you even can, like an individual asset valuation. But I think one of the things that has to change is for the ultimate lenders, you know, in the space, you know, the banks, and then also I would say the debt capital markets need to get on board with that, because I think that really what, you know, is that's something that really influences how we look at valuation. And, you know, when we size loans up for rental properties, we look at two things. We look at cash flows, so a debt service ratio of, you know, 1.2 times or better. And then we typically, you know, lend up to 75 loan to value. So you have kind of dual constraints.
Right.
And the reason we have that value constraint is because when we look to finance our loans with lenders, they look directly through to the properties. And so they want a, you know, valuation that has been done because these are residential assets. And so the mindset for banks and the debt capital markets are, these are residential homes, they're underpinned as residential assets. And if for some reason there's a downside scenario, you would sell these properties as residential assets. Therefore, we need that, you know, underpinning of value to really constrain, in a lot of cases, what you can lend on it. Makes sense, but, you know, as we get more and more into the single family, you know, rental space, and people do see these as income, you know, producing portfolios, then hopefully, you know, the groups that are kind of behind the underlying, you know, debt that's provided to the sector will get more comfortable with a cap rate approach, much like they do in the multifamily world.
Yeah, I 100% agree. And just, you know, I think on you made a comment on the horizontal apartment complexes that are on one parcel. It's the same for self-contained subdivisions of build for rent. If all, whether they're on fee simple lots or not, if it's all one subdivision, you know, the agencies aren't looking at it any differently. And, you know, if you take a historical view on the single family portfolio investment space, you'll get all the answers you need. If you're a big, you know, debt provider, they were and have historically been more stable, unlike the rest of the commercial real estate asset classes that they've been providing, you know, debt on over time. You know, when in the last recession, most single family rents stayed stable or even went up because the demand for housing was necessary. You don't see that in multifamily, and you're not seeing it today in multifamily. You know, during COVID, you're certainly not. It's not as bad as it was in the last recession for multifamily,
Right.
but you know, where the single family rents are growing at 3, 5, 7%, multifamily rents have, you know, nationally declined.
Right. And Danielle, as an operator, how are you guys approaching acquisitions and, you know, projects that you're considering? Are you, you know, cap rate driven? You look at valuations? Is it a mix? Like, how do you guys think about value and what you guys, you know, invest in?
Sure, it's really a combination. We are looking to buy in areas where, you know, speculatively there's room for appreciation, while still maintaining, you know, a minimum cap rate. I think that we really, we have a model that we run every property through and see if it meets, both criteria as well as what the banks are going to look at it as, to be able to determine the long-term approach, a certain cash on cash that we'd be able to attain with the long-term financing. So.
Got it. Got it. And then Jason, as part of the, the Roofstock platform, in terms of how you're broadcasting the suitability, are you advertising, cap rate? Is it valuation? Like, what are the types of things that, as it relates to valuation, your constituents want to see when you're advertising these portfolios, for instance?
Yeah, that's a tricky one. And I kind of agree with what you and Michael were saying. I think at some point we will mature, to where lenders are looking at the income as opposed to strictly, the sales comparison approach. Since most of our investors on the retail marketplace are leveraging financing, just because the rates are still pretty historically low, we tend to take a sales comparison approach look, just because there will need to be an appraisal, and you want that likelihood of the transaction going through. Certainly a lot of these homes make a lot of sense when you look at them purely from income approach, but you struggle with appraisals still in markets like Memphis and some in Detroit and St. Louis, where a home may be worth $100,000 purely based on the rent, but comps only show 70 or 80,000. I still think some of those markets are a little limited by comps, but you are starting to see homes trend higher and higher, even in some of those smaller, lower price point markets. And I think it's still going to take a while to get there where we can advertise things on a, we're talking internally about an IV, like an income valuation model, and building one ourselves. But I still think it'll be quite a bit of time before lenders are utilizing something like that. We love the AVMs, and they're a quick barometer, to run a valuation on 1,000 homes or 300 homes at a time.
Right.
But ultimately, there's so much noise when you look at them on an asset by asset basis. I think it can give you a good snapshot of somebody's portfolio, but when you start digging in asset by asset, there is a lot of variance. But I think those methods and models will get so much better over time as we see more and more trades in the space mature.
Yeah, I think that's a really good point. It's everybody's, you kind of look for triangulating on value based on cap rate, based on the underlying valuations of a property. And, when you have a large portfolio, you might have some less desirable assets. And so if there's something wrong with that asset, then it washes out because of the portfolio effect, right? When you have smaller portfolios, it becomes more of an issue. I mean, we still value and we underwrite, portfolios, and we look at every single asset. We get an appraisal on every asset. And, as a lender, that's actually has saved us a few times, because you'll see pictures of homes that look great, but kind of go to the side, and it's, if you've ever seen the movie Blazing Saddles, it looks like a Western set. It might not have the back of the house. And so you want to protect yourself from those types of situations, whether you're a lender or a buyer, right? You just can't, buy these in mass without checking it out. So it'll be interesting to see if some of the newer technologies, evolve to where, the AVMs, they seem like they get better and better, but, I know there's a lot of tech groups that are really focused on those types of, technologies that can, be used on a more mass scale now that there's so much interest in the space. I guess we'll see on that.
Yeah, and just to add to that, I mean, you're both right, and AVMs are great, but at SFRhub.com, which powers our brokerage, I mean, and you gotta clean and verify the data as best you can, or the AVMs are pointless. You got to get some boots on the ground. You got to know what you're looking at. You got to utilize human capital still, and we get asked this constantly from commercial guys that are coming into the space. How do you, show us some portfolio comps, which you just can't do, because there isn't one portfolio that's even similar to another portfolio. Even if it's 50 homes and 50 homes in the same MSA, you're going to have 50 different homes, unless, they were all built in the same year by the same builder. So when for us and thinking of lenders, we always value each home based on what we believe that true retail value to be. And the cap rates are just what they are. You can't arbitrarily put an income approach together like you can in multifamily, where you just know in a certain market, they trade at 5.5s or they trade at 5.25s. You got to look at every single home in a portfolio. You got to determine the value, you got to look at the income and expenses, and that determines a cap rate, from a single home to aggregate. So it's a challenging world, but I would love to see the lenders get more aggressive on the income approach for these stabilized portfolios.
All right, well, with that, we're going to end it. Thank you again so much for participating. Really appreciate everybody's time today. Take care.
CoreVest is the leading lender to residential real estate investors. For more information about our long-term rental loans or short-term bridge loans, visit CoreVestFinance.com.